Russell, how you doing today?
Doing all right. I kept saying Happy Tuesday over and over again in the chat, so I'll just bandwagon on that one. Happy Tuesday.
Look at this guy. Yeah. You look beautiful in your red, man. I mean, I wish it was
Wisconsin
red, but I get it.
Thank you. It's Big Ten red. Let's all be on the same team. We're going to come down to having the national championship's going to be a Big Ten SEC All-Star game.
Probably. I mean,
something ridiculous like that.
Double R, what's going on, man? How you doing?
Not much. I had been looking at Oracle earnings as well. The 10% move is not out of control. We had a 35% gain in the stock, I think 3 quarters ago. So that's something that you guys were just talking about that just kind of popped in my mind. I was like, I think they had some massive double-digit moves. So, it's not out of the question to be pricing in something along those lines. And everybody's making money on semis, but I just wonder how much longer the people that are buying the semis are going to be able to keep funding that. Because I hate to throw corporate finance out at everybody first thing in the morning, but there's only so much cash flow left among some of the big tech companies to apply toward AI until they start to have to raise money. And I'm honestly surprised when Google announced they were going to do a secondary that to help pay for AI. That's generally not how companies like to fund stuff. So, happy Tuesday, but maybe a bit concerned and kind of wrong with respect to what's going on in the market.
That's a good.
The market's telling me I'm wrong. So I started to start out and go, well, I'm short semis. I'm not short semis, but I'm concerned about them.
Do you think we're going to start seeing a wave of like secondaries coming up?
I have all these cash flow numbers in front of me, which would bore everybody to death. But Meta's going to have to do something, and Amazon's going to have to do something. Google didn't necessarily have to raise money, but I think they chose to do so just to get ahead of things. They got Berkshire Hathaway on board as part of the secondary, which I think is kind of like a positive endorsement and also has a bit of an unusual structure to it. But companies tend to like to fund these things, fund capital expenditures through cash flow. And when you look at cash flow estimates for Microsoft, Google, Amazon and Meta, which are 4 of the 5 biggest customers to NVIDIA, they're not going to have much cash flow left next year in 2027 to keep funding the build out. So they're going to have to do something. And you're doing that at the same time as, SpaceX and who did you guys just mention that, or I just heard that there was a client, OpenAI maybe,
yeah.
Just filed as well. Well, that money's got to come from somewhere. And I don't think people sell their McDonald's stock to buy SpaceX. I think they ship something that's a bit more tech oriented over to their SpaceX.
Is there does this show up in vol? Is that why vol is so high in these individual names and we're seeing the skew? Is there any way we could see that vol wise?
You mean as far as just looking at what the implied vol is right now, maybe on some of the near-term shadows?
One company is more likely to raise cash than another, and the vol is higher in that one, or something along those lines.
Where you might be able to look is, what's going on with their debt, and I really feel like I'm exploding people's brains first thing. But if you look at the credit default swaps on the companies. Which is very, in my mind, if you were going to create a risk index for individual stocks, you'd combine something around out of the money implied volatility on the put side and what's going on with the credit default swaps. But yeah, I think, and just mentioned that Oracle's, it was just mentioned that Oracle hadn't been pricing in a 10% move, even though they've had some big moves lately. I think that increased pricing around earnings and how earnings are becoming a bit more of a risk event after an excellent first quarter. That we had one of the best first quarters earnings wise that we've seen in a long time across the board. But when you're spending more than you're bringing in, I just don't know how much longer you can keep that up. And when you're spending more than you're bringing in, you're going to have to raise money somehow. And it's generally considered a sign of weakness when a company issues equity and doesn't issue debt for capital expenditures. It means that the debt markets weren't willing to lend them money at a favorable rate.
Yeah, especially for Oracle, there was a stat that was kind of staggering that I found yesterday, writing this earnings preview. But it was something like over the first 9 months of fiscal year 2025, they spent $12 billion, and this year, the first 9 months over 2026, they spent like almost $50 billion. So there's like a 4x increase, and I think that could be what's driving this implied volatility too. Like if you're going to be spending this much, you got to be matching it with orders through 2027, et cetera, and revenue like out the wazoo.
Yeah, and the AI, the leverage or the amount of leverage that you get from offering AI services, I just don't get it. I mean, I pay my $20 a month to ChatGPT, and I think I pay Claude something. But how many people are actually going to do that, and how leverageable is that? And is it going to cover all the expenses that are associated with doing some sort of AI offering? And you've got to assume, much like I had a great mentor, this math professor from Harvard that worked for Merrill Lynch forever, and he liked to talk about macro waves. And the last one we had was the internet. And if you do recall the internet, we had dozens of silly companies. We don't have a bunch of silly AI companies right now, but there was eventually a shakeout, and then we just had a handful of companies. The first industry I ever followed was the auto industry. The auto industry in the 1900s, everybody that had a wrench was trying to put a car together in the early 1900s. Then we ended up with 3 big companies. So I think there'll be a shakeout within AI as well. If you're trying to play the winners and the losers, look at who's got the better consistent cash flow to fund these things and may not have to go to market. Microsoft looks like the strongest one to me, but they're also increasing their I hate Microsoft for this, but they're on a June year end. So you can't do an apples to apples comparison, but the year that's about to
we used to be like that.
I know.
Was like that.
But we're on a June year end, and they're looking at spending 116 billion this year. They're projected to spend 180 billion next year, and that's going to take their free cash flow from 63 billion to 33 billion. They're going to be cutting into cash flow, and what I would love to hear out of them in their earnings call, which will be their year-end earnings call, which companies are always a bit more honest on their year-end earnings call than their quarterly earnings calls, what their plans are for CapEx, how they're going to fund it. And if you're thinking about looking out a few weeks to an inflection point, Microsoft earnings are something I'd be keeping an eye on, especially when they're coming out in July, when some people are going to be on vacation, et cetera. So maybe there's not as much liquidity. I saw somebody mention that we had a relatively light day option trading yesterday. So I've been thinking about that Microsoft 2026 year-end earnings number that we'll get about a month from today as maybe being a wake-up call to an awful lot of people.
Russell Rhoads, professor at the Kelley School of Business at Indiana University, the champions of college football. Got to give you that. We got a couple minutes here. I do want to get your thoughts on VIX and the VIX complex.
Oh, sure.
Russell knows more about the VIX than most people have ever thought about. What are you seeing here recently? Is there anything to give pause to, any reasons coming up for markets to do anything crazy?
Well, we're relatively, I feel like everybody wants to know what to trade today, but VIX is really giving us more of an indication that in the fall, there are a lot of concerns. I think the midterms are probably hanging over the market a bit. As much as talking about high volatility, the VIX is at 18 and the June future is only at 18.20. If the volatility guys were worried about the equity markets right now, that June contract would be in the 19s at least. So VIX is actually telling us smooth sailing right now, even though it's at an elevated level, and looks more bullish on equities than it did a week or two ago.
I'm literally asking because I haven't looked. I don't think we have, honestly, but I think it's important. VIX and the VIX of NASDAQ is probably more of an interesting story right now. Have you looked at that at all? Is there anything you're seeing in that?
I haven't looked at VXN, but
Nobody's
I know what
talking
it's
about
supposed.
it, right? I mean, it's kind of interesting.
You know, typically it's at let's see, 27.7 over 20. It's at about a 35% premium to VIX right now. It's more than a 35% premium than VIX.
Okay.
Typically, it's usually, I think, 15 to 20% has been more normal, but it does widen out. We're not in earnings season right now for tech stocks, but it does widen out during earnings season and come back together. That's something that I've looked at historically, that because you have just a handful of stocks dominating the NASDAQ 100, you do see more of an earnings seasonality around it. It looks like earnings season, and we're not in earnings season, which means that there's that kind of day-to-day, I guess there's that kind of day-to-day announcement risk around tech stocks right now.
That's what the ball looks like in the individual names.
Yeah.
Yeah.
It's it is kind of wild. It is wild. But Mr. Russell Rhoads, thank you so much for your input. We appreciate you. We will see you
No
next
problem
time.
whatsoever. Anytime. I appreciate it.
Sounds good.